Hey everybody, Chris Pulver here. It is just before midnight and also before Election Day. I thought it'd be a good time to send out a video. I know this might get people all over the world as they're hours ahead of the U.S. here as we go into pre-election. But just had a bit of a restless night, and we got a lot of stuff to digest this week, including the U.S. election plus the Fed on Thursday. 1,200 plus companies reporting earnings. And just wanted to send out a video out there and see what the markets are doing and what I'm doing to position for things. It's really just paying attention, having a lot of dry powder and cash at the ready for big opportunities if we have them. So let's just dive into the charts and take a look at a couple things. I'll start at the top. Let's go into the SPX or S&P 500. We've had 2 weeks of pullbacks to the tune of around 3%. So here's a high, here's a low. We actually poked some fresh lows today briefly. We've been down about 3.07% from the all-time highs. The NASDAQ, of course, has not quite made all-time highs. So we breached back here on the 29th of October, but quickly faded hard. This was Wednesday. So this would have been Tuesday's close, Wednesday's direction on the 30th. Halloween was a bit on the scary side for everything, took out the previous week's lows. But looking at the higher time frame here, NASDAQ has not made higher highs since the middle of July. So I'll get to the higher time frame charts in just a moment, just kind of taking a look at the recent price action. So, the NASDAQ has had a pretty decent claw here, 1, 2, 3, 4 weeks back to these recent highs. Last week turned bearish really with that big giant drop from Wednesday to Thursday. And then Friday, we ended up finishing near the lows. Today, we revisited again. Certainly looks vulnerable to the downside, at least for some pullback and volatility. And I would expect that the election this week is going to deliver. I've mentioned this a few times this week already, just today and Monday with all the live sessions that I typically do. Look, we have the U.S. election on Tuesday, and let's say this is just my scenario. If we have a winner Tuesday evening, look for Wednesday's close to provide some 2-week guidance. Okay, I did a webinar last week and it was interesting. Looking back to 1996 to now, with all these election years, the Wednesday close the day after the U.S. election in the S&P 500. If Wednesday closes green, the market actually stays bullish for a couple of weeks. If the market closes red on Wednesday, the day after the election, the market stays bearish for a couple of weeks. Now, I say if we have a winner on Tuesday because that's my biggest concern. Let's say election drama. Okay, election drama. If we do not have a winner Tuesday. So let's say that the electoral college is showing that Trump is victor or Kamala Harris is victor, and yet states are showing that they're not able to get their votes in, or there's going to be a recount, or there's going to be all sorts of stuff, and it's going to be dragged through the day to day from Wednesday, Thursday, Friday until a winner is declared, and all these states are going to be urgently trying to gather votes. And I don't know. Basically, it seems like we don't have a winner, and there's potentially election fraud, or one side is declaring that it's all fake, and it's whatever. I don't care which side it is. It's a problem either way. I don't think the market's going to like any of that. So if we don't have a clear winner on Tuesday, then I'm braced for uncertainty and volatility. Right? So how am I doing that? Hedges. For me, I'm mainly hedging on the following. /ES, so the E-mini futures, /MES, /MES, the micro E-mini futures, and NQ and MNQ. So a lot of my hedging is done in the futures market. And I have some long puts. I've got some butterfly spreads. I've got some broken wing butterfly spreads. I have some bear calls or some bear put spreads. I have some bear call spreads. I've got quite a few things out there, mostly in the futures market. Also, some very inexpensive long puts. I did this today in actually a trade. I put on some trades on the SPY and the Qs, and I went out to November 29th. It went out 29 days to expiration, and I bought a 10-cent and a 12-cent put. They cost next to nothing for me as a hedge, but if we have some type of crazy event where the market hates this uncertainty and we see a 3 to 5% correction in a day, that's going to cause some crazy movement in the options market. So something like a 12-cent debit may end up paying maybe $1 to $2 a credit. That obviously helps me make a couple of bucks on my hedge. helps me offset any type of crazy drawdown that we might be experiencing with a healthy correction like 3 to 5%. The S&P, if I'm not mistaken, halts around the 7 to 8% handle. So if volatility gets really wacky and we see the VIX spike up and we see some crazy price action, look, I'm just looking at it this way: anything can happen. And when anything can happen, you can tell that the market is bracing for uncertainty and bracing for volatility. And, sitting here near all time highs as the Fed has already cut, as the Fed is looking to cut, as these inflation numbers are coming out, and the bond market is saying one thing like, hey, the Fed's just not cutting and things are going down to this perfect, no landing, soft landing scenario. I mean, the yields have been up literally since the rate cut in September. In fact, the bond market probably bottomed and rallied the hardest when you have bonds dropping the way that they've been dropping, and you look at the yields rallying the way they've been rallying. The 30-year mortgage went from 6.09% now up to 7+%. And it really is like, tick for tick with the swing in the U.S. 10-year. So all these things are concerned in the bond market. It's going to put more strain on the consumer, more strain on businesses and restructuring. Anything that's financing 5+ years, go 5 to 30 years. That's a big window to refinance things. That's a big window to restructure things. That's a big window to take on any type of long-term debt. And if that is going to be influenced by a yield that's rising and rallying, that puts a lot of stress on the U.S. economy. So all that being said, I am hedged pretty heavily, to the tune of maybe a couple percent of my total portfolio. But this is the way that I'm doing it. And as far as stocks go, I'm sitting in, let me do the numbers on this here. I'm probably sitting in just under 50% cash right now. So I got about 950K in cash out of a $2.35 million portfolio. So about 40% of my portfolio is pure cash ready to deploy. So what does that look like? I was going to put here ready, sitting in cash. So sitting in cash, ready for good opportunities to deploy. Now, if we start to see price do something like this, okay, if there's no real pullback and we're, up to these highs in the S&P, we've had a 3% pullback. If we start to go higher again, I'm probably not deploying all that cash at all-time highs. Okay. I mean, we know that Buffett is selling Apple shares like crazy. We know that Buffett's dumping a little bit of Bank of America and he's dumping some Coca-Cola or maybe increasing some Coca-Cola. I mean, he's putting tons of money into U.S. Treasuries, that's for sure. But anyway, sitting here at all-time highs, if we start going higher, I'm not going to deploy a lot of cash at all-time highs. Now, I will say that if we start showing some nice discounts, we're at 3% right now. Let's say that doubles to 6%. Let's say that gets to the 8 to 10% level, like we saw back in July to August when that thing, the markets crashed, 10% in the S&P and 15% in the Qs, and the futures market was even more volatile. The Qs actually went, NQ was almost 20% from top to bottom from mid-July to the spike in August 5th. So if we get, 8 to 10% pullbacks, then I'm going to start looking to position size, start adding some good opportunities. And the timeline on that would probably be at least 6 months out, probably closer to 6 to 12 months out, and just give the market time to settle in. And I could still be wrong. I mean, 8 to 10% could quickly become 12 to 15%. Does it get that bad? I don't know. Seasonality wise, I would expect November to December to still cooperate to the upside. The markets still try to get back to these recent highs. S&P gets back to all-time highs. NASDAQ runs to the July all-time highs. Dow has pulled back 3+% from the all-time highs. Russell 3-4% from the recent highs, but they're still 11% from all-time highs back in 2021 and early 2022. So again, we have opportunities, but what I'm looking for is, do I have pullbacks that look a little bit more attractive? So I'm sitting in cash, ready for good opportunities to deploy. What does that look like? I've showed this chart here several times. If I just go to the higher time frame, let's start at the SPY. Okay, as an example, we're sitting here at a 50-period moving average, and I would love to see this be, it's a level. And so I've added some credit spreads in here. I think if we go higher, those trades are totally fine. But they're just kind of run-of-the-mill, little risk-defined stuff. If we go deeper, well, that's a 100-period. That's a 144. That's a 200. Am I interested in adding to all three of them? I would say I'd add at the 100 and then the 200. Okay. If we come any lower, I'm adding down here at the August 5th bottom. So I'd say 1, 2, 3 levels. I'm willing to basically dollar cost average in on pullbacks if we get them. I'm willing to increase my trade size as well. So if I went 1 contract, 2 contracts, and then even 4 contracts, keep it all risk defined as an example, like just a call spread whether it's a debit or a credit spread, doesn't really matter. So it'd be a, if you want to do a credit spread, you do puts, sell put, buy put. If you want to do a bull call spread, you buy a call, sell a call. But if I did contracts 1, 2, and 4, if I gave it time and this one gets back to the middle, if I win on this one, break even here, and lose on this one, I still make money. If I get all three of them right, we can kind of, for lack of a better word, like waterfall these or snowball these into profit. Even this is break even and you win on this one, that makes you some money. We don't have to get back to all-time highs, but this is why I'm trying to be patient, waiting to see if this market wants to do anything silly. And when I say silly, it's like, yeah, just a pullback. We could have a 5 to 8 to 10% correction, and the market may not like it. Investors may not like it. It might cause the typical like panic effect, which is what we see, like when this happened in July to August, that late July, FOMC, and then early August over the weekend. It was a Thursday, Friday, Sunday in the futures market. When we opened on Monday, this market was absolutely beat up over a 3-day window, like one of the biggest sell-offs we've seen in a long time. I mean, that was an 8% chunk in 3 days of trading, and that was at the open. So, I mean, like I said, the market halts itself around 7 to 8%. So I'm just trying to be prepared in case something crazy and wild happens, because it's been too easy to just watch the market make all-time highs. We're 47 all-time highs in the S&P. I'm sure the Nasdaq has competed with that. The Dow's been doing a pretty good job as well. The Dow's not up nearly as much, but we have over 20% in the S&P, 20+% in the Nasdaq. We've got over 20 to 30% gold, 30+% silver. I mean, Bitcoin is up a ton. We've got some crazy stuff going on, and would it be easier for the markets to go to all-time highs? Yeah, I guess. But do I want to be an individual stock picker? No, I mean, not necessarily. I mean, we've had some good rotation. We've had some good market breadth. It's certainly a lot better and a healthier feeling than just going Mag 7. In fact, just tonight I read that BlackRock is going to release a new ETF that's going to focus on a top 20 allocation instead of a top Mag 7, which I think is great. I mean, I've always been interested in having like a top 10, top 20, top 50 even of the S&P. Like take the top 10% of S&P and let the good do better. And if that's rebalanced with the top 10 or the top 20 or the top 10%, I freaking love it. So, I mean, that's pretty easy ways for the passive investor to kind of allocate, stay pseudo diversified, but also, concentrated to the tune of good companies rise to the top. And in a market cap weighted instrument like the S&P, I mean, large cap and market cap weighted certainly, drags the market higher. Even if that's all that's performing well is the top 10 or top 20 companies, it's enough to drag the market higher. If you want to trade equal weight, then go RSP, right? RSP is equal weighted S&P. And also, they pulled back off the recent highs. RSP is sitting here around, same thing, about 3% off the recent highs. We've also made lots of all-time highs here in the RSP. You go to QQQE. This one, interestingly enough, actually got to new highs from November of 2021, got to fresh highs here back in July, and we've actually eclipsed the highs on the equal-weighted NASDAQ, which I think is interesting considering the large cap QQQ has not quite gotten to those July highs. So this right here shows a healthy broadening to show that equal weight is somewhat outperforming. Now I say somewhat because you can tell by this chart, pulling back 3 to 4%, there is a lot of potential support here. I mean, is this a topping pattern? Maybe, right? But that top was just invalidated. So unless this is going to fall all the way back down to this equal low back in August, I'd still look at that as an opportunity to buy. Because look, how hard would it be for the market to do that? If we're not in a recession, people aren't losing their jobs, why would we be sitting here looking at this massive, massive, massive correction, right? And also on the QQQE, the only reason I'm not heavier in the QQQE is I can't trade a lot of options around it the same way with premiums like I can on the QQQ. That's why I'm not in it as much. But as far as an instrument having some allocation to this, I think it's great. QQQE is very affordable considering the QQQ is 486. That's a huge difference in price. If you go to RSP, this one's trading at 176 instead of an SPY that's 569. So for equal weighted, I'm happy to have this kind of market breadth and rotation out of Mag 7, get into, hopefully more companies that can run with it. A rotation into sectors like utilities, rotation into financials, rotation into defensives or anything's just not tech and not communication services. I think I'm good with that. So I do want to maintain some allocation to these equal weights. I think they're performing well. I just don't see the same type of premiums as you would in the liquidity that you would in the SPY and the QQQ. So that's the only drawback that I really see between the SX. Fact, I'm gonna do this now. I'm gonna go ahead and add in RSP and add in QQQE and move these up. So RSP can go all the way towards the top of the food chain here in my watch list. So right there, and all the way down here to the QQQE, moves all the way up here towards my Qs. There we go. So we got the Qs. So now I have my S&P, so SPX right here, your SPY, your equal weight, your futures, micro futures, NASDAQ Qs, equal weighted futures, micro futures, Dow, DIA for the ETF, also the futures market for the Dow, IWM, AVUV for Russell. Then you got the RUT, RTY, and then micro. This would be your micro E-mini for Russell. Volatility index. Here we are with slightly higher volatility. Again, we've seen higher lows since summer. We had our volatility event that's the equivalent of what we saw back in January 2018. Does volatility go higher? Possibly. Does volatility retrace? Possibly. I don't know. Volatility is very fickle. But if we have election drama and the market's selling off, you can probably guess that the volatility index here would be above 2378, possibly getting into the high 20s again. Even during a bear market like we saw back in 2022, we had some steady volatility into the 30s. We didn't have a vol event. We didn't go up into the 40s, 50s, 60s, but we had steady volatility into the 30s and mid 30s multiple times as we had a nice 5-wave correction, lower highs and lower lows until that market bottomed in late 2023. And then we had our Mag 7 that kind of saved us with a trench at the bottom. And then from there, it was blast off, late 2023 into 2024. Actually, I take that back. That'd be late 2022 into the rally in 2023 and the continuation into 2024. But healthy, bear market with good volatility, everything's going to be different. There's no real model to say that this is what the market's going to do today. Nobody knows. I am saying that for me at all-time highs with the Fed cutting rates and a crazy contentious election up ahead of us, and potential drama around it with people questioning the integrity of the democratic process and the voting process, that makes me want to hedge and just be a little bit more protected from anything wild and crazy, and also have lots of cash at the ready in case opportunities present themselves. Example, if we have a 5 to 7 to 10% pullback in the markets, I know it's scary to deploy capital. But if I deploy that capital with a longer term mindset, meaning probably 1 to 2 years out, I think that type of deployment and that risk would be rewarded going out far enough instead of being so short term. Now, short term, I want to hedge, but longer term, I want to be long. I mean, if you think about this, you can look at any interview from, I'm trying to think, Howard Marks or Peter Lynch or anybody that talks long term. I mean, look, if you want to know when the SPY is going to be higher, look out 3, 5, 10 years. Historically, there's never been a time in the S&P's history that over a 20-year window, if you at least had investment last for 20 years, you are 100% in profit. Like it's all, I mean, you could be literally 1% profit, but after a 20-year stretch at the worst possible time in the S&P, you've had at least profit after a 20-year period. And if it's a 10-year period, it's like 95 or 97%. So it's ridiculously probable that profits will be made with a longer term horizon, right? But that's not what everybody has the time for. Not everybody has 10 years. Not everybody has 20 years. Just saying, even going out 1 year gives me at least the confidence to kind of fix things. And one thing we haven't seen for a while, this has been kind of wild and crazy, is think about the boom and bust cycles we've seen since 2018. I mean, it is remarkable to think that this market for the last 6 years of trading has done nothing but basically go to all-time highs, crash, 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 right? Go to all-time highs, crash. Okay, go to all-time highs, retrace, all-time highs, crash. I mean, I would say that August pullback was a crash. It just got picked up right away. All-time highs. If we have another crash, I mean, look, I'm equally as concerned if we have a pullback to this level. That looks like we're doing some massive damage. But we could still have a pullback to the backside of that trend line. We could still have a pullback all the way back to the same highs. You notice what hasn't happened? You notice how we haven't just had flat anything? It's up and it's down, it's up and it's down, it's up and it's down, and it's up and it's down. That's insane to think about that volatility we've seen for the last 6 years. So I wonder if this market just settles in on some type of range, that might look a little tricky to trade, but we essentially go sideways for the first time in 6 years instead of having rally to the moon, asset bubble, and then it has to break and reprice and revert. And then asset prices balloon again. We have to break something and then something, that's what's been the most frustrating thing for me as a trader the last 6 years is just watching booms and busts. And that's becoming the new norm. And it feels like we don't have a normal functioning market because it's so heavily influenced and manipulated by the Fed and central banks and their narratives and their transparency. And the market sometimes doesn't want to do anything without them. And here we are this week with a big election, plus a lot of earnings, plus the Fed, and the market's sitting here like, yeah, it's ripe for a pullback, and we're getting one. But can that pullback be magnified? Maybe. And so I wouldn't be shocked if there is a spike lower that ends up finding some price action to support it higher. And I'm just looking to see just straight up at the 100, at the 144, at the 200, or at my August lows, just playing the game carefully, picking some levels with risk-defined trades, namely options. If that works out, I'm at least going to take some stabs. Now, the timeline is going to be interesting. Do I want to go out for just a couple of months to get through the election, let the dust settle? Do I want to go out to Q1 as we typically have these nice bullish markets in that window from November, December, January, February, maybe into March? And, as they say, sell may go away, which is historically inaccurate, but it feels like the market, has this a summer sideways range or some type of slowdown. I don't think that's necessarily true. But from November to at least January, I'm going to be pretty focused on staying somewhat bullish. Is that a guarantee we go up? No, not at all. But if we have some volatility and pullbacks, I like that. So pulling back on the SPY, pulling back on the Qs, okay, pulling back on the Dow. We're already starting to pull back. Now I want to see if we have some decent spikes into these deeper levels, the 100, the 144, the 200, possibly that August 5th bottom. Okay, same thing on the Russell. A lot of good dynamic support, but I want to see if we have some spikes here that we can start scooping up some lower levels, and I think that's a good spot for me to start allocating some capital. I'll watch the volatility index. I'll watch the dollar index. I've been telling traders for weeks now, I don't have a clear direction on the dollar outside of waiting for the dust to settle. Right now, I see resistance and I see support. I think let's let the election and the Fed get over with this week and see if we go higher on the dollar or lower on the dollar. To the downside, we can revisit lows. From the upside, we can revisit. There's structure here around 105.50. There's resistance and resistance all the way back up towards 106.50 to 107. I don't know what the dollar wants to do. I don't care. I think that if the dollar is going to get weaker, that's a good sign for all equities to rally towards the end of the year. Okay. I hope that is the case, honestly, because I think that would start bringing things back to reality, like the yields. Bond market can kind of come back a little bit. Yields can drop. Fed continues to cut. But we're still going to have the whole debate on inflation over the next couple months to see what that data looks like. U.S. oil, off the lows pretty nicely. I'm out of the oil positions right now. I'm concerned that oil will continue to pester these lows, and in order to keep inflation somewhat tamed, I think that U.S. is going to continue to produce at high levels and put tons of supply in the market and push these pressures lower. Even an escalation in geopolitical tensions in the Middle East is not pushing oil prices higher. So I think if we break these lows, that keeps inflation numbers looking better when really we're just breaking down in energy. And so I don't have any positions on oil right now, and I'm just going to let the dust settle. I don't care. I mean, I don't need to force a position if I don't really feel confident that oil is going to be direct or non-directional. If we stay range bound, that's fine. I'm just not participating. Natural gas, also all over the place. I'm a little hopeful that we can pull back into equal lows here, but if this just starts to rip higher, then I am not playing natural gas. Gold, I get a lot of questions on gold every single day. What's gold going to do? Same thing on the other stocks that I look at. Same thing in the indexes. I'd love to see gold just pull back. Just something. We're 270 plus bars since we hit the 200 EMA. Percentage-wise, we stretched into double digits here. We are around almost 14% overstretched from the 200 EMA. So I could see a pause in gold before we go higher. I could see a pullback in gold before we go higher. I would prefer a pullback, and I look to position again. Here's a 50, here's a 100, here's a 144. Any of those levels to me look pretty good. So probably won't touch the 21 because that's been super shallow the entire time. But a 50 period or 100 period, probably looking at some exposure and then revisiting the 200 and also some very strong trend line support. Area 1, Area 2, and look to be longer term on gold and stay bullish on gold. I like gold quite a bit. Now those percentage levels, let's say we pull back from highs, that's a almost 9% correction. That's a 13.5% correction. those are great. I think those are really attractive levels to be looking to get long. Now, whether I get those opportunities, I don't know. But if I do, I want to strike. I want to strike. Silver, same thing. We pull back towards the 100, 144, 200. Pretty good dynamic support. Measure move for me at 35.80. SLV and SI futures. Bitcoin, this is going to be an interesting one to watch for the remainder of the year. Through the election, through the Fed, what does Bitcoin do? We had that huge rally last week into the all-time highs. Didn't quite hit them yet, but they're right there. And, is this going to be another accumulation zone just on the right side of this break? So we have this nice trend and channel, and it broke the highs. Do we pull back and retest and accumulate here and then start to go higher? If we get to all-time highs, is that momentum that carries Bitcoin into 100K? Maybe. Or does it completely fail and get back into the low 60s or even low 50s and be a complete bull trap? I don't know. But if we break higher, I'm going to be participating with Bitcoin quite a bit. BITO is a way I can trade some options. Despite this one pulling back a decent amount, this one's frustrating. IBIT is probably the best priced looking one for the BlackRock ETF, and then FBTC, same type of thing. So if Bitcoin is going to go higher, I think if you want to trade that kind of correlation wise, trade IBIT and FBTC. MicroStrategy's been leading the way. I almost bought some shares on MicroStrategy today. I did not. I'm hesitating on that. So I'm doing some dollar cost averaging at 200, 175, and 150. Small account or small trade size, like literally $1,000. And I'm just going to dollar cost average in at like 5, 6, and 7 shares. Allocate about $3,000 of capital. My break even is going to be around 175, and from there I can kind of control some options and some credit spreads and some other things that will let me generate some income, lower my cost basis a little bit. Ethereum, still need to break above 28.15. I've got some trades on Ethereum. Foreign markets here, DAX, this is the German market. Do we come back into some nice supported levels? Again, watching very easy to follow moving averages, the 100, the 144, the 200. If we find those levels, looking for some dynamic support, see if we can stage a rally back up to the highs and we just can buy the dip. There's very little risk here to buy low enough that we see it pulling back, closing back above, buy trade, stop below, and then go after a nice little trend follow, eliminate risk along the way. Stuff like that is pretty good. Okay. FTSE, that's your UK market. And we had a bit of a breakdown here. It's been a really good range trade for the last couple of months. We're sitting here at the 200 EMA, same type of thing. If you're buying this level, tapping the lows, going back above, buying, stop loss below this trend line. Do we get back to these recent highs at 84.05 or beyond? Good reward to risk there. Hang Seng, 1.5%. This is actually going live right now. So China is actually up. Let's see what we're looking at here for the other stocks. I'll see this market tomorrow during the U.S. Open. Alibaba, Baidu, FXI, JD. But right now, Hang Seng is up. That's a good sign. If we go to the Shenzhen Composite, that's another one that I watch here. Let's see, Shenzhen. Let's go Composite. See if it shows it. Nope. How do I spell it? I think that's right. Expressway International Holdings. Fudge. All right. Well, anyway, I was looking at another kind of benchmark for China, but we'll see what that does for tomorrow. Junk bonds. This has been steadily going lower. This is another precursor to loosening credit conditions. I know if you've been reading the news, there's been tight credit spreads. Your triple A's, triple B's, triple C's, they have been as tight as they've been since 2007. But with the J and K heading lower, that's showing that there's a bit of loosening out there. Is it and is it a problem right now? No. I would say it's a problem if we have a big move to the downside, then yes, we're going to see some wider spreads. We're going to see a lot more volatility. I would say that you go to your, IV ranks and you watch them swell. This is where the hedges can really pay off. I mean, I basically went long puts with this type of implied volatility. And if we swell into these bigger levels, then that gives me, added acceleration with gamma that anything the downside might be able to pay out really nicely for a short-term hedge. So we'll see. But I'm watching this to see, are things breaking? Are things breaking when the market is dropping dramatically? So far, not so much. It's kind of an orderly pullback. But if we start to get some, really obvious lower highs and lower lows, then that could be a problem. Until then, we're going to look to see if it's pretty well supported. And that should probably do it here. I think time-wise, I've gone over, about 30 minutes in. So I'll wrap it up there. I'll put a pin in it. But like I said, a little bit of a rest this night. We got a big day tomorrow with the U.S. election. Look, I hope for the best. I'm sure that, I'm kind of indifferent to the whole thing. I just hope there is a feeling of democracy and a feeling of authenticity and a voter process that can be trusted. And it's not going to be like one side says this, the other side says this, and there's no more middle, there's no more compromise, there's no more democracy. I know that seems extreme, but man, it's what it feels like, and I hate that feeling. I hate that feeling as a U.S. citizen that things can be that divided and feel that broken. So obviously, as a trader investor, I'm curious what price does, just like everybody else. The best thing I can do is not overextend and leverage. I don't want to put too big of positions on. I want to have plenty of cash at the ready. I'm currently hedging more for the near term. And of course, when the dust settles, there will be some decisions to be made. If the opportunities are there for the taking, I will be ready to strike. So hopefully stay tuned for more. If I see something interesting this week, I'll post another video. But I'll talk to you all very soon. Thanks for following. Thanks for watching, and I'll see you soon. Thanks. Bye.